So hopefully you get the reference in my thumbnail. I won't spoil it. So we're going to be covering DGRO, iShares Core Dividend Growth ETF from BlackRock. So just to remind everyone, I've covered this previous video. So the idea, we're talking about growth, dividend growth investments. That's where I'm steering you, and this is where I've steered myself. So it's a discipline of dividend investing that I believe in. And to remind you, I've shown this before, dividend growing stocks perform very well over long periods of time. All right. So won't get into it any more than that. I have another video. You can go watch it if you want. So here is the website for DGRO on iShares. So you can look at, they have a whole bunch of bells and whistles here. You got total return. Here's a hypothetical $10,000 from 2014, what you'd have, distribution dates. So it pays the vast majority ETFs pay on the same cycle, March, June, September, December, because that's where most companies pay dividends is that rotation. So that's when most of your ETFs pay, unless they're a monthly payer. So some other stuff we'll go over. Expense ratio is very low, which is part of the reason I like this. So it's a dividend growth ETF. Your expense ratio is exceptional compared to some of the other dividend focused ETFs that you'll find out there. A lot of them are like 0.3, 0.4 expense ratio. So we see the performance, some key factors. So when you look at any ETF, and we'll go over this, I'll have other slides to show. So you find where the benchmark index is for your ETF. All right. So this is Morningstar's US Dividend Growth Index. We'll get into that website later. So you want to know where they're pulling their information from. Okay. So you can see here, this is a broadly diversified low fee ETF. So it has 450. It doesn't have to have 450. It can fluctuate on their methodology. So now, one thing to remind people, so this is a standardized yield that's required by the SEC on any ETF. Go look the term up if you want to understand. The reason they did it, they wanted to have a common standard so you could do a fair comparison of different ETFs, because otherwise they could show you any sort of yield, right? So this is the yield you can compare actually between different funds. If they have a yield that doesn't say the 30 SEC, I mean, you'd have to dig to find out what they're actually basing that on. Is it the trailing? See, this is the trailing 12 months yield. So there's different factors, and you can understand that on your own. So here's all their fancy scores, like ESG. So it's a BlackRock fund. So ESG is part of investing with BlackRock. If you don't like ESG and you don't believe in it, then you probably shouldn't invest in BlackRock, because they were the ones that created it. Like Schwab does not follow ESG. All right, so we got some more ESG goodness. Talking about nuclear weapons. That's amazing. Okay, so we'll go over the holdings later. So here you go. Here's the exposure. So you see, your eyes are not deceiving you. There are 11 sectors, and they only are showing 10. So you're like, well, where's the 11th? They do not have real estate of any kind in this ETF. So no REITs. The reason they don't have REITs is because they're trying to not expose you to non-qualified dividends. So they're trying to focus only on qualified dividend investments in this ETF. It's another reason I like this ETF. You could have this in your Roth or your personal brokerage. I don't think it's I think it's a decent investment. All right. So here's some of the sheets. Now, every ETF you look at, there's a fact sheet, and then you should look at the prospectus. Some of them have like an abridged prospectus. So this has a summary prospectus. So it's much shorter than the full-blown one. And then they have annual reports and so forth. So this is the fact sheet. It just gives you like a snapshot. It's like a resume. Let's say it's like the resume of the ETF. It's like 1 or 2 pages that shows you exactly what you're getting into. So all the particulars, the holdings, the dividend yield, the benchmark it tracks, the expenses when the fund was launched. Pretty standard stuff. The sector weightings. So basically, if you know, like the 5 of the 11 sectors make up over 70% of this ETF. And I like how it minimizes your exposure. So dividend growth is, you want growing dividends. So this minimizes your exposure to utilities, which I really like, and materials and communication. I love that. In general, you don't need communication exposure in a dividend growth fund. So I think they have exposure in the places that I would expect them to, for something like this. Here's some other information. So here's the prospectus. So a couple things this is the summary prospectus, not the full one. So some highlights I would show you. So here's the expenses again, 0.08%. Hypothetically, if you own this for 10 years, you'd only pay a grand total of $103 per 10,000. So that's just great. Portfolio turnover. This is something else you should look at. So what's the average turnover of the fund? So last year was 22% turnover. So that's pretty high compared to a index, like that S&P 500. But is it good or bad? It's up to you to decide. It might produce more taxes for you, let's say. Depends how you hold it. So it goes through the strategies. The prospectus will tell you what the investment strategies of the fund are. So how they pick stocks, how it gives you all the particulars that you want on that ETF. So you should definitely read through the prospectus. And the summary one here is 20 pages. It goes through how they pick stocks, and then it goes through risks. So they define risks of holding this ETF. Concentration risk, would be one to pay attention to. Dividend paying stock risk, they're just saying dividend stocks may fall out of favor with investors and underperform the broad market. So they identify that as a risk. Financial sectors risk, because financial sectors are more heavily weighted in this, and so is healthcare sector. So you can go through that. They show you some performance measures, which I can show later also, how the fund's doing, tax information. So most likely you'd get some sort of capital gains, you'd get some short term. It would vary. The taxes would probably vary year to year on something like this. But their goal is to produce qualified dividend returns for you. So most of it should be qualified dividends, which is favorably taxed in the US. So once you look at the actual ETF's website, so you look at the prospectus and the fact sheet, then you should go to the website of the index that it tracks, and then you should look at information on that. So here we go. It's the Morningstar US Dividend Growth Index. So here's all the documents that you can look at, how they reconstitute it, the schedule, and then there's some the rules for how they actually pick stocks for this portfolio, which we will go over. So it covers some stuff here. You can look at the metrics of the ETF. So just looking if I want to really talk about any of these. Not so much. The Morningstar website on the side you can download. So here it is. This is the selection criteria. So no REITs, because they want to mitigate non-qualified dividend exposure. Non-qualified dividends will be taxed at your normal income rate. So they want to minimize that, because this is for dividend growth. So I like this. They will not take any companies that are in the top 10% of dividend screen for yield. So that means they're trying to kick out like the more mature companies. So they're not going to have a lot of the really high yield dividend stocks in here that honestly don't grow very fast. So they're going to kick out. They'll kick out Verizon. This would kick out Altria. So this is not. There's other funds for those high dividend yield ETFs. So this is focused on the growth aspects. So here again, consensus earnings positive. So I like that. So there's some metric of positive earnings forecasted. So this is very forward looking. Some of their criteria. A lot of forward-looking criteria here, which I think is a positive. Less than 75% payout ratio, which, if it's not a mature company with a high yield, you probably want something in the 40 to 60% payout ratio range would be what I would look for a dividend growth company like this. Okay, so 12 months we talked about. They must currently be paying dividends at least corrupted annual dividend growth. Dividends count towards dividend growth requirement if the annualized indicative. So here they talk about how they decide if it, like, what's considered a growing dividend, the metric. So basically 5 years uninterrupted dividend growth. Last point. This is what I don't like. So I have a criticism. I don't like this metric. If a current index constituent fails to raise its dividend, but does not decrease its dividend and executes share repurchases in the preceding 12 months, resulting in a net decrease in shares outstanding, the constituent will remain in the index. I really don't like that one. So potentially they would keep in a company that's not a growing dividend stock anymore. The only positive I could see of this is, like, maybe if there's a good dividend growth company, but they come across one bad year. Overall, I like the selection criteria here. No, people are not making any decisions. So this is all formulaic. Okay. So the number of stocks is variable. So a lot of dividend ETFs have like a set number. So they'll have like a pool of selectable stocks, and then somebody picks like 50 or 100. This one, there's no set amount of stocks. So it could fluctuate. And then the last part of this fund we'll talk about, they equal weight. I should say the index is dividend dollar weighted, which is interesting. So they're weighting in proportion to their total value of the dividends expected to be paid out in the next 12 months. So again, we're forward looking. They cap individual companies at 3%. So this is not a market cap weighted index. It's basically like equal weighted, almost, you could say. But in the dividend growth world, I mean, you're looking for low volatility, like stability. So I don't have any feelings, good or bad, about that. So here's the current holdings from the last reconstitution, which was last December. A lot of the reconstitutions are at the end of the year. So you can see, they don't have like Altria, Verizon. You don't have those typical ones. So they basically get all the winners. I mean, you got all the normal. What I like about this, like, you don't have to hold these individually. There's a lot of good dividend growth ETF or dividend growth companies here, and then you get exposed to them, but you don't have to own them. Merck, Broadcom, great companies. So I like the makeup. You've got your tech. It's not like overly pushed towards like Verizon, AT&T. Like, I see so many dividend ETFs, and then they have like Cardinal Health, and it's just like I don't like the mix up. So here's the reconstitution. So I pulled this from their spreadsheet. Reconstitution is in December. It's when they put it back together. They take it out, or they reconstruct it every year for once. So they pull out stocks and they put new stocks in. All right. Rebalance. They don't change the stocks, but they change the percentage allocations in the fund necessarily. So they're doing that quarterly. That's typical. So if we look here, so what I was going to do, we always got to compare it to SPY, right? So if you do charting historical prices, wow, I do not like this. What the hell is that? Why did they change this? Oh my God. Okay, that sucks. When the hell did they change that? Used to be a drop-down menu. So, I mean, we're comparable. This freaking, why did they do this? So you're on a total return basis the last 5 years, you are doing better than the S&P. All right. 10 years, not so much. Well, that one's not fair. But so you can see this is a very, this fund performs very well compared to the S&P. And you might say, well, why don't I just buy the S&P? I mean, I'm not stopping you from buying the S&P 500. You go right ahead. I'm just reviewing a dividend ETF. So here's what I'll show you. So why would you buy this and not SPY? So this is a simple non-compounding calculator, which means I'm just projecting if you bought a share of each and you're not reinvesting the dividend. This is literally just you bought a share of each one. So you can see the difference when you get out to 10 years, the yield on cost is getting pretty sizable. You're almost, you're getting to double when you get to 10, 12 years. I mean, you're getting a pretty big difference in the yield on cost on the dividend, because you can see the right now SPY, you get about 5.8 right now growth on that dividend. DGRO, you're getting almost 11%. So if you put this out, I can't go that far. So by like 20 years out, you got a 7% yield on DGRO. You're only at 4 with SPY. I mean, this is why you would invest like this. If you don't believe that, if you don't believe in this and so forth, then you don't have to buy this. But you're buying it for the appreciation of the dividend, and you're also going to get a pretty good market compound rate, I think. Nobody's going to say you're going to match SPY or beat it. So here's just a rough example. Let's say, again, I'm just reiterating the differences. So let's say this is a capital appreciation of 8%. The market compounds at 7, right? So I'll do 8. Dividend growth, I put what SPY's is and the current yield of SPY. And then here's DGRO approximate values. Let's say you don't get 8%. Let's say you're underperforming. You only get 5% capital appreciation. And the growth is what it is right now. The key you have to understand is, like, in 10 years, there's not much difference. They're about the same. At 20 years, 242, 255. Okay, we're starting to pull away now. So by 10 years in, there's practically no difference. All right, no difference. The magic is when you start getting from 20 to 30 years. Now look at the compounding effects of a dividend really kick in. So you got 242, and you end up with like 600,000, right? But here with DGRO, you're talking, you could go from 255 to almost $1 million if these values held up over time. So you're valuing the higher appreciation of the dividend if you invest this way. You were supposed to hold it. And this is like same idea as a dividend snowball. It takes so long. You build it, you build it, you build it. You don't feel like you're doing anything like for 10, 20 years. You feel like you're wasting your time. You don't see the value. And then later on in life, it just kicks in right when you need it to. From 20 years on, most calculators you could look at, from 20 years on, it's just a rocket ship. So that is there. So again, here's just, you can use this website, Portfolio Visualizer. So I just went from 2010, because I figure after the start of like the boom, right? Let's say you start with 10,000, and then I'm like, okay, well, what if you're putting like a Roth type amount per year, 4,000? Okay, and you're reinvesting the dividend. So SPY versus Drogo. So far, you can see it's about the same. So like I said, the first 10 years, they're pretty close, right? So it takes like long time. So after 10 years, then you start to see those compounding effects of the dividend kick in. Nobody can predict the future, but it's a different idea. You're valuing the appreciation of the dividend in with the stock. So you can see they pair pretty well. So that's there. So that is DGRO, the first ETF review. As far as my opinion, I like it a lot. I think for someone younger, this could be a great part to your portfolio. If you consider this a core or I could see it, honestly, I could see it meets the criteria of a core and a satellite investment to me, because it's low fee, broadly diversified. You could consider it either one, I think. I've seen channels where they would consider this a satellite holding. But like I said, it could be a core or satellite holding. I like the focus on qualified dividends. So if you wanted to hold this in a personal brokerage and not a Roth, I don't think it'd be a terrible idea. I think it could be held in either of them. honestly. So this is one of my favorite ETFs out there. There's other ones I'm going to review. I'll review some that I don't like at all, because I'll show you why I don't like them. And you'll see the difference in allocations, especially the high. I should probably do a high dividend ETF one next, so you can really see the difference in the type of companies they select. And then the criteria is much more focused just on like yield. But the criteria of this very forward. A lot of the criteria they're using are forward looking. So that's something I think is going to perform well. I mean, nobody's got a crystal ball, but so leave me a comment. If you have any questions, let me know. Hopefully this worked out. And I'll do more of these later on. If you have a specific dividend focused ETF you want me to review, put in the comments. I'm not going to do. I'm just going to do the dividend ones. All right. Like, I don't think you need me to review SPY or QQQ or VU. I think you understand what you're buying with those. So I'm trying to give different perspectives. I probably won't do covered call ETFs for a while. I really don't want to do those for now. Later on, I could do CHEPI maybe, but that much down the line. I want to talk about other more interesting dividend focus or dividend growth focus ETFs for now. All right, this is part 2 of the summary. Do this a few days later. Now it's the weekend. So I didn't really cover dividend dollar weighted rules that DGRO follows. So like we said in the video, 3% cap that gets adjusted quarterly. So Microsoft is going to get weighted down next time they do a rebalancing of this portfolio. So this method, this dollar dividend weighted means that they look at the company's dividends paid calculated by the total outstanding shares. Then they factor in the free float, so the actual shares that are on the market, and then the annualized dividends per share. That's how they calculate the weightings of this dividend fund or ETF. So you can see when you look at the holdings, it makes sense, right? So you got the big guys: Apple, Microsoft, Exxon, JP Morgan, Johnson Johnson, Chevron. These are the big dividend payers. Large companies, they have got a lot of shares, so they have a lot of physical dollars going out the door. So they're weighted higher in this fund. The 3% rule, though, keeps those larger companies from being too high of a percentage of the total balance of this portfolio, which is different. I think they're just trying to make it less volatile and emphasize more the growth. Because if you didn't cap and you just went on the dollars paid per dividend share, then like the top 10 would probably be a much higher proportion of the total fund. So the 3% cap makes sense because this is a growth dividend fund, right? If this was just a dividend fund, they probably wouldn't have that rule, but they've set it up so they're trying to keep the higher dividend payers in this methodology lower cap, and they're trying to place more emphasis on the growth. So the smaller companies, which would most likely be growing more. So you can see how DGRO works in a broad sense. They take all the companies that have positive forward earnings projected. They're paying growing dividends. It doesn't say how much of growing, just growing, right? So they're in this pot that DGRO takes as the company matures. It's growing. Earnings are growing. At some point, earnings maybe stop growing. They start to flatline, maybe, and then at the same time, or maybe slightly before or after that. So either that kicks in, or the dividend starts to stop growing. The company's kind of rounding that hill in maturity, and then it's probably got a higher yield. So this fund cuts that 10% off the top. So we're trying to stay away from these mature dividend, cut them out, and then what happens? That money comes, and they grab new, younger companies that are again are growing earnings, growing dividends. So basically, they're trying to cycle into growth dividend investments. It's trying to stay away from the mature companies. So it has a very specific intention to why this ETF is set up this way. So hopefully this has been helpful to you. I didn't really cover. I don't want to like date this video per se and like give valuations on what it's holding. I mean, as of right now, I'm in June 2023. Apple's been on a tear. You could say, so it's pretty. You could say it's maybe fair overvalued. Like to say, are we going to like look at every individual company in this ETF and say if it's fair value or not? I don't know. I don't know if that's really worth your time. You understand the methodology, how they pick stocks. Do you agree with it? And then you just let the thing run. I don't really have much of a problem. The only like I don't particularly, I wouldn't buy Coca-Cola, so that's one that stands out. I don't buy Apple just because it's the largest company in the world. It's already in my other funds, so I wouldn't own that. I wouldn't have any. I had J.P. Morgan for a long time. I've had Johnson and Johnson, Chevron. I think that's a solid hold itself. AbbVie's in a little bit of a weird place with their patents, so forth. Pfizer, okay. Pfizer's okay. Procter and Gamble, great. Long-term hold. Home Depot, love it. Broadcom, amazing company right now. It's done great. Pepsi, I wouldn't buy Pepsi right now, just holding it. Cisco, meh. United Health, great long-term hold. Little struggles this year. So, I mean, I like what's here, just on a broad sense. Texas Instrument, I like it, and so forth. So, but that's not why you buy an ETF, right? You're not trying to value each company it holds. That's not what they're for. You're just buying a basket, and you like how they pick the stocks in the basket, and the fees are lower. So that is DGRO. You decide. This could be held, like I said before, you could hold this in a taxable account because part of their strategy is intentionally to pick qualified dividends. So it would make sense in a taxable account. But I still think the appreciation of this over long periods of time, it's a great pick for a Roth also, honestly. But you're not looking for tax preferential investments at that point. So to each their own. Hope you enjoyed this. I'm not going to, I covered like the basics of ETFs in this video. I won't do that again. Like, what is this? What's a prospectus? What is this? So I might do a separate video where I just go, here's the basics, how to look at an ETF. And that way I don't have to say it. So I can cut down these ETF reviews to, I don't think these need to be that long. I'll try and do 10, 15 minutes for these ETF reviews in the future. And then I'll just leave like the how to look at an ETF. I'll do that like a separate video. This went on longer than I wanted to, so I'm sorry about that. But I think it's a good option for people. If you're 20, there's not a lot of dividend growth ETFs I found, honestly, where it's specifically objective. You could have dividend ETFs where they end up being great dividend growth, but like this one specifically, its approach is to find those. And there's Wisdom Tree has one, and I think there's one other I found. So I'll cover those. I mean, these are great options. If you have time on your side, these would help. These are better, I think, options if you're younger, 20, 30s, and so forth. So with that said, thanks for watching, and hopefully you enjoyed it. And I'll try and do better and focus these more as I do a few more ETF reviews for you. This was the first one. So have a good day.
Thank you for your cooperation. Good night.